Hello everyone, and welcome to the BDO Financial Reporting webinar. My name is Raisa, and I'm joined today by my colleague Moses, who may be a familiar face to some of you, and we are from BDO's Technical Financial Reporting team. So we expect today's webinar to last approximately 50 to 55 minutes, including some time for Q&A. And then we'll just do some housekeeping while some people are joining. So if you'd like to ask any questions, please use the Q&A function, which you can access from the icons at the bottom of your screen. Time permitting, we'll try to answer the questions during or at the end of the webinar, or we'll get back to you after. Please note that if you click the option to send your questions anonymously, then we won't be able to contact you after. A recording of the webinar will be available online. Now, please note that this webinar is appropriate for CPD self-certification, and you can self-certify with your company. All right, so that's it for housekeeping, and hopefully we've got a full house. So let's get into the meat of today's session, which is focused on key reminders for December 2023 reporters, as well as so it's a bit of a summary of things that we've covered, but also some new items that preparers should keep in mind. And so on the next slide, we've got the agenda. So we'll start off by looking at some developments in the IFRS and UK GAAP space, specifically those standards and amendments that are newly effective for December 23 reporters, and then looking at some developments in 2024 and beyond. Then we'll look at some key messages and hot topics coming out of the regulators. So we'll look at some feedback from the FRC and some feedback that we've seen from the European regulator, the ESMA. And then lastly, we'll have some updates in the climate and sustainability reporting space, as well as around UK audit and corporate governance reforms. And now I'll hand you over to Moses, who'll kick off the IFRS and UK GAAP updates on the next slide.
Thanks, Raisa. And if we just move on to the next slide, please. So here we've got a list on the left-hand side of the newly effective standards and amendments from 1 January 23, and on the right-hand side, amendments effective in future periods. It might look like there's a lot, but actually it isn't that much, and it isn't that far-reaching. And we, as you will see from the annotations there, we've covered some of these off in earlier webinars, and we're just going to touch on a few of those today. So in terms of the fourth one down on the left-hand side, we've got amendments to IAS 12 deferred tax related to assets and liabilities arising in a single transaction. Like I said, we covered this off last year, actually, in our December webinar, and the key message from this one is that you might have to account for deferred tax on some transactions where you previously hadn't, and this is about a change to the initial recognition exemption. There was diversity in practice with regards to how people accounted for deferred tax on leases and decommissioning provisions. There was an amendment to the standard, and the initial recognition exemption, which means that you don't have to recognize deferred tax, is not available for transactions such as leases and decommissioning provisions where you have equal taxable and deductible temporary differences arising. As far as we're concerned from a UK perspective, we don't think this is a big concern, but do watch out if you have multinational operations. You know, the accounting does depend on the tax rules, so you need to familiarize yourself with the tax rules first to understand how deductions are given, and then assess whether you need to recognize deferred tax on the lease or the decommission provision. The other one I'm going to talk about on this slide is the first one on the right-hand column, amendments to IAS 1 presentation of financial statements. This was a bit of a saga, as you can see from the dates on the slide. It started back in 2020, then there was amendments and further amendments. So this has now been finalized. In terms of the key messages from there, there's clearer guidance on how you account for covenant breaches, how you assess covenant breaches, and how you would then classify as current and non-current, depending on whether or not you have a covenant breach. But the key change in terms of accounting arising from this amendment is to the classification of convertible loans where the conversion option fails the definition of equity. If it meets the definition of equity, then you have a compound instrument, and you would classify the liability component as current or non-current based on when the payments are due. But when you have a conversion option that fails the definition of equity, i.e. it's classified as a liability or derivative liability, and that conversion option can be exercised at any point in time, then even if you bifurcate, i.e. account for the embedded derivative and the host separately, if the option can be exercised at any point in time, the standard has been clarified or changed to state that you would have to account for that liability as a current liability, even though your expectation might be that you're not going to pay any cash in the next 12 months. Again, this is something to watch out for in your disclosures going forwards, but also if you are entering into any complex financing, that you understand the impact of this on your balance sheet and any covenants. So if we move on to the next slide. Again, this is one of the ones on the list on the left-hand side, IFRS 17. Now, clearly, if you're an insurer, IFRS 17 has a wide-ranging impact, and you will have done all your work already and be ready for this. We just want to highlight on this slide a couple of areas where things might slip through the net. On the left-hand side, we've got their financial guarantee contracts. That's where you guarantee the borrowing, say, of a subsidiary, or subsidiary guarantees the borrowings of the parent. Now, these contracts do meet the definition of an insurance contract in the main. And in the past, there was an accounting choice to account for these contracts under IFRS 4, which is the standard which IFRS 17 replaces, or IFRS 9. In terms of what we used to see in practice, we saw a lot of companies apply IFRS 4 because applying IFRS 4 allowed them to adopt IAS 37 by proxy, which meant that you would only make a provision for the financial guarantee if it was probable that there was going to be an event of default. Now that option to account for it, say under IAS 37, has now gone. So you either use IFRS 17 or IFRS 9. IFRS 9 takes you into the expected credit loss provisions, and you would have to account for the guarantee that way. So the message is, if you previously asserted that you were doing IFRS 4 in your financial statements and you can't do that anymore, and you're going to have to do a bit more work to assess what provision is required, either under IFRS 17 or, as we anticipate, most people will move to IFRS 9. So that's the message on the left. And then the other one is product warranties. Again, product warranties are generally exempted from IFRS 17, and you would account for them under IFRS 15. But watch out for where you have the warranty being issued or underwritten by an entity that is not the retailer. In those cases, then you would have to look into whether IFRS 17 applies. So again, just something to watch out for. So if we move on to the next slide, and here we'll be talking about an amendment to IAS 1 and the IFRS Practice Statement 2, disclosure of accounting policies. So you got on the slide there, what's happened has been an amendment to the standard, and the amendment changes one word. In the past, you had to disclose significant accounting policies, and now the requirement is to disclose material accounting policies. There's guidance and illustrative examples in the practice statement, and it's effective for this year end. So what do we expect that to mean? So if we move on to the next slide, the first question is, well, what is material accounting policy information? And the amendments clarify that accounting policy information relating to immaterial transactions does not need to be disclosed because it's immaterial. But even if you have material transactions, you don't necessarily always have to disclose the accounting policy. And the key driver here is to get entities to focus on how you've applied IFRS to your circumstances. So it's better to remove all the, shall we say, boilerplate disclosure that simply replicates the requirements of the standard, and focus on, well, what is your transaction. So for example, let's say a share-based payment, describe the complexities around it, describe how you've accounted for it. It might be that there was a judgment as to whether this was a cash settled or a share or a share settled transaction, and it's about explaining how you've applied the standard to the specifics of your transaction, rather than giving generic information. And then on the far right hand side of the slide, we've got a question. So if an accounting policy is immaterial, does that mean, which means, let's say that you are omitting accounting policy on a certain transaction, does that mean that other IFRS disclosures for the transaction are also immaterial? So the answer to that is no. So just because you might think, well, all I've got is fairly vanilla share options, so the accounting is set out in IFRS 2. I'm not exercising any significant judgment there. So can I leave out all the other information about the weighted average exercise price or number of options that are exercisable? So the answer to that is no. So whilst the policy information may not be material, the actual information may still be material. Related to a transaction may still be material. So if we move on to the next slide, again, so when might you expect to give disclosures? Let's say if you have a change in an accounting policy, then that in and of itself would warrant disclosure. You'd have to explain why your new accounting policy is better than the old one, and that's useful information to users of your financial statements. Similarly, if the standard allows an accounting policy choice, then you ought to state how you're accounting for it. So, as a very simple example, investments in subsidiaries could be accounted for at cost, or sometimes equity accounted, sometimes fair value. Again, you ought to explain which choice you've made. Similarly, if you've got a transaction where which isn't covered in IFRS standards, and you've developed an accounting policy using the hierarchy in IFRS 8, again, that's an area where there's an expectation that your disclosures would be quite extensive, explaining how that policy has been developed and how you're applying it to your circumstances. Because if it's a transaction that's not covered by accounting standards, it probably is quite a different or unique transaction. Similarly, if you're making significant judgments or assumptions in the application of the policy, you would expect disclosure of that. And also the final box there on the right, complex transactions, for example, where you have a transaction where there's a judgment on the scope. Is this transaction partly in the scope of one standard and partly in the scope of another, or fully in the scope of a single standard? Where you've got to make that judgment, then there's an expectation that you would explain how you account for them. And clearly, there's always the point about linkage to the front end. If you're describing a complex transaction in the front end of your accounts, there's going to be an expectation that you've got decent disclosures in your accounting policy notes on it. So moving on to the next slide. We're now listing here the IFRIC agenda decisions, and apart from the first one, they're all rather niche. You might even say the first one is quite niche, but I'm going to touch on it on the next slide. But again, not saying much on these. You've got links there to the IFRIC updates, which summarize what the issues were and what the consensus was. In terms of IFRIC agenda decisions, there's generally no timescale for implementation, and how quickly you implement an IFRIC agenda decision sometimes depends on regulator expectations. So some regulators expect immediate implementation, whereas others will give you a bit more time. So again, gauge what your regulator expects and then decide when you're going to adopt these new agenda decisions. So moving on to the next slide, and we're just going to touch very, very briefly on definition of lease substitution rights. And why are we touching on it? Because I think in practice we have seen entities say that a lease doesn't exist when the supplier has the ability to substitute the leased assets, and in the actual case which was brought to the IFRIC, the customer entered into a 10-year contract with the supplier for the use of 100 similar new assets. They were batteries for electric buses, and the supplier had the practical ability to go and substitute the batteries throughout the contract. But the question was, well, in order to avail yourself of the exemption, you have to have the practical ability, but also it needs to be economically beneficial to the supplier to substitute the batteries. And in the fact pattern described, the conclusion was that it would not be economically beneficial for the supplier to substitute the batteries in the first few years of the contract, and therefore on that basis the substitution right was considered to be not substantive, and therefore the contract contained a lease. So again, if you've availed yourself of the exemption, you might want to have a second look at it in preparation for the year end. So moving on to the next slide, we're just going to touch briefly on the next couple of slides on UK GAAP. And again, we've covered this off in our March 23, our March webinar, where the FRC have proposed a few changes to IFRS 102 and IFRS 105. The actual amendments to the standard have been delayed, so we're expecting them in the first half of 2024 with an effective date of not before January 26. So again, it's just worth making a note of that in 26 we're probably going to be expecting changes, and we're probably going to have to be preparing for them in 2025, which isn't that far away now. So if we move on to the next slide, again, this is just a reminder slide of what to expect. But we're expecting changes to revenue and leases standard to align them with IFRSs, so IFRS 15 and IFRS 16, if you're familiar with them, with some simplifications. So again, that's probably the biggest headline of the expected changes. And if you do have complex arrangements with revenue, or you have a lot of leases, we would suggest that when the amended standard comes out, that you have a look at the requirements and start preparing for them. And this is just, again, speaking from experience of the implementation of IFRS 15 and 16, which we saw people underestimate how long it would take. In terms of the other headlines, fair value, that it's being aligned, the definition has been changed to align with IFRS 13. Again, this is more stuff at the edges. And then some changes for small companies. And then on the far right hand side, the one I would draw your attention to perhaps is the third one down, business combinations and goodwill, where there'll be enhanced, or there is enhanced guidance on identifying the acquirer and identifying whether a payment made in a business combination is considered to be consideration for the acquisition or remuneration. Again, those are thorny issues, particularly if you operate in the IFRS world, and there's some alignment, but also some clarification of the actual requirements. And the last point on this slide before we move on is uncertain tax treatments, again, alignment with IFRIC 23, which probably means earlier recognition of provisions for tax when you have an uncertain tax position. So if we move on to the next slide, this is where we start looking ahead. What are we expecting over the next year? I suppose that the The biggest one we're expecting is IFRS 18, which we've presumptively called it IFRS 18. We don't know for certain, but it will replace IAS 1 presentation of financial statements. We do have a flyer for this, which is explains what the expected changes are going to be, and we'll have a link for it later on in the on one of the slides. The next one down, business combination disclosures, goodwill and impairment project. Again, this is going to be, we're expecting this to come out early next year. Enhanced disclosure requirements for certain acquisitions, and expecting changes to IAS 36. Again, we'll cover that in more detail in the future. Third one down there, IFRS, the accounting standard on subsidiaries without public accountability. You might think, well, we've got IFRS 101 here in the UK, so do I need to worry too much about that? I'd say you should probably keep a watching brief on it, and we'll see where UKIP go on this one, or the UK Endorsement Board goes on this one. And finally, FICE, which is a lovely abbreviation of financial instruments with the characteristics of equity. That project, that ED came out, again, enhancing disclosures, and there probably will be some changes to some financial instruments that have characteristics of both liability and equity. So with that, I'll now hand you over to Raisa, who will talk about messages from regulators.
Yeah, absolutely. Thank you, Moses. So we'll now move on to messages from regulators. And if we move to the next slide, we'll start off with some feedback from the FRC. Now, many of you will know that the FRC releases its review of corporate reporting annually, which provides an overview of its activities for the year and the findings from its various reviews. So the report on the 2022-2023 year was released in October of this year, and as always highlights the top 10 financial reporting issues that the FRC identified. In general, the feedback this cycle was that there was an increase in the quality of financial reporting across the population of companies that the FRC reviews. And on the slide in the next, we've got the top 10 issues listed. So we'll run through briefly what the findings were on these issues, and then we'll talk a little bit more about the top 3 in the next few slides. So if we start here with number 4, which is on strategic reports and other Companies Act matters, a lot of the comments here were around whether the strategic report contained sufficient information to be considered useful and comprehensive and fair and balanced as it's required to be. So the FRC was expecting to see discussions on large impairment losses, where there's been material movements in balances, or where there are significant balances in your balance sheet or in your cash flow statement. That's what they're expecting the discussion to be around in the strategic report. There were also some questions around dividends and whether those were lawfully paid, given the Companies Act requirements around that. And then at number 5, we had financial instruments, which was a top 3 matter in the prior year. And so there has been a decrease in the number of queries around this, but it still required 5 companies to have to restate their primary financial statements. For financial services entities, many of the questions were around ECL. For non-financial services companies, it was around whether there was sufficient information given on material risks arising from their financial instruments. And if we move then to the next slide, we've got number 6, which is income taxes. It's everyone's favorite topic. So this one also slipped down the ranking, showing that fewer queries were raised. The 2 most common aspects that the FRC questioned were reconciling items in the tax rate recon. So really, are those understandable? Do they make sense? Should they be reconciling items? And then also question the support for the recoverability of deferred tax assets where companies had a recent history of losses. At number 7, we had revenue, where again, queries were lower than in prior years, but of a similar nature. The interesting thing with revenue is that there weren't any restatements, so it seems like people are at least getting the numbers right, but a lot of the questions were around the disclosures. So was there sufficient disclosure provided to enable users to understand really the more complex areas of revenue? So for example, principal and agent considerations, variable consideration, contract balances. And then at number 8, we had provisions and contingencies. So here there were quite a wide variety of questions asked, but there were no restatements. I think here we just wanted to highlight that we think provisions and contingencies will remain a top 10 issue for a while. And that's because we're expecting to see new provisions coming out of climate legislation or climate litigation or penalties and fines, as well as changes to existing provisions. So if we think of our restructuring provisions of decommissioning obligations because of climate-related matters. So I think this is one definitely to keep an eye on. And then at number 9, we had presentation of financial statements. So this is an area that resulted in 7 companies having to restate their financial statements. And the most common issues were the classification of items on the balance sheet as current or non-current, the presentation of items in P&L, and the adequacy of accounting policy disclosure. And I think that ties very well to the amendment we're seeing around IS1, around what accounting policy should you actually be giving and moving away from boilerplate disclosures. And then lastly, at number 10, we have fair value measurement, which has moved into the top 10 this year. And we covered the findings from the FRC's thematic review on fair value in our June webinar. So if you're keen, you can listen to that. We do expect fair value to remain a key issue given the current volatile market and economic situation. And we'll touch on this briefly in our hot topic section. So if we then move on to the next slide, we focus on the top 3 issues. So starting with number 1, which is impairment. Now, in the current review cycle, more queries were raised on impairment than in previous periods. That isn't unexpected. We would generally expect to see more instances of impairment or even reduced headroom in an environment of higher inflation. And hence it's sort of moving up the rankings. The questions that were largely raised were around the disclosure. So the non-disclosure of your key assumptions, related sensitivity analyses, and inconsistencies between assumptions and other disclosures. And so this word consistency, you'll probably hear me saying quite a few times. It is a theme that's kind of running through a lot of the feedback coming from the regulators about are your financials telling the same story as, for example, what you're saying in your front end? And so our top tips around impairment is consistency. So really making sure that if you're, for example, discussing negative performance indicators in the director's report, considering is that also an indicator of impairment, and should that then be discussed in the impairment note? The other place that often is asked for consistency is around how inflation is taken into account. So are you adjusting the discount rate in your various calculations? Are you adjusting the cash flows? For example, in your value and use calculations or your fair value calculations, and how are you dealing with inflation? IS36 is also quite a disclosure heavy standard. So we say always use a disclosure checklist, make sure you've ticked all the boxes around that. And then lastly, just kind of avoiding that generic boilerplate disclosure and making sure that your disclosures are clear and entity specific. If we then look at number 2, which is on judgments and estimates, and it's returned to be one of the highest ranked topics in the top 10. Now, judgments and estimates is not really a standalone topic, right? It's really you're disclosing the judgments and estimates that you've used in your other calculations within the financial statements. And so a lot of what I've said around impairment would apply equally here. It's really the questions were around not having sufficient disclosure to understand those most significant key judgments. And here our top tip is really to avoid a generic list of judgments and estimates. So often when we look at financials, we would see a fairly generic list of that's roll forward year on year, that these are the significant judgment areas. And so what the FRC is saying is revisit those lists, make sure that they are, those really are the most significant judgment areas, and that you actually explain what the judgments that you're applying are. So the one we always see is, for example, judgments on the useful life and residual values of PPE. So if we're comfortable that that is a significant judgment area, then what that note needs to explain is really what judgments have you applied. So for example, is it because you've made a climate pledge to get to net zero, in 10 years, and as part of that process, you're going to have to replace a number of your items of PPE, but that timeline is not quite defined yet because there's a lot of new technology that is emerging. And is that then what is causing the judgment, as opposed to just saying, that there's judgment in that area? And yeah, so that's just something to have a look at your sort of list of judgments and estimates. And then at number 3, we've got cash flow statements. Now, for those of you that have been looking at the FRC's reports for a number of years, this is not anything new. Cash flows remains the most frequent reason for companies having to make prior restatements as a result of CRR queries. And the queries that were raised in the current year are largely aligned with what we've seen in prior periods. And so on the next slide, what we have is some top tips. So one of the things that the FRC has said is that we should complete a robust pre-issuance review of the cash flow statement before it's issued, and that will help you to avoid some of these common findings that they have. So that seems like a fairly obvious point, that we review the cash flow statement before it's issued. But I guess we wanted to give you a little bit more on what would be a robust pre-issuance review. And so on the slide, we have listed some really top tips and tricks that we potentially do when we look at cash flow statements, and that could form part of that robust review. Definitely not a comprehensive list by any means, but some tips and tricks. So if we start off with number 1, which is checking for consistency between the cash flow statement and other information in the financial statements. So for example, if you're adjusting your cash flow statement for non-cash expenses like depreciation and impairment, then the amounts should tie to what is in your is in profit or loss or in the related expense notes. If you're adjusting additions of assets, so you've got that is in your investing activities, for example, then that should tie to your related asset reconciliation. Your changes in working capital should then be easily reconciled with your movements in the statement of financial position. At number 2, we have non-cash items. So we do find non-cash items sort of creeping into the cash flow statement. One that we often see is around leases. So we might see acquisition of a right-of-use asset being disclosed in investing activities. Now, if your lease payments are not prepaid, then we wouldn't generally expect that to be the case. So leases is definitely one to look out for. The other place that non-cash items can kind of creep in is interest paid, interest received, tax paid, and dividends received. So a quick trick is to compare the amounts in your cash flow statement to the amounts in P&L, and generally we don't expect those to be the same. And the reason for that is that the amounts in P&L will often have accounting adjustments or accounting accruals going through, accounting interest unwinding, and so they wouldn't be representative of cash flows. So that's a sort of a trick to find some non-cash items. And then at number 3, we have netting. So as a general rule in your cash flow statement, you shouldn't net. So you should be disclosing your cash inflows and your outflows separately. So in particular for things like borrowings, proceeds from repayments of should be separate. But because netting is really only allowed in your cash flow statement in very narrowly defined circumstances. So if you've got netting, then just have a deeper look at that. At number 4, we have classification. So classification is one of the ones that often result in restatements. So whether something is operating or financing or investing. This is particularly true for new or significant once-off transactions. So here we often see errors, for example, around business combinations. If you're paying the transaction price or the purchase consideration, then that's often an investing activity. But if you're paying transaction costs relating to that business combination, then that may well be operating activities, for example. So classification is definitely something to keep in mind. And then lastly, we've said, consider the composition of your cash and cash equivalents balance. So if you've got sort of normal run-of-the-mill bank accounts or petty cash, then that's fairly straightforward. You would know that those are cash and cash equivalents. But if you've got bank overdrafts or you've got short-term investments, then you need to think about whether those should be in the cash and cash equivalent section of your cash flow statement, or if those should be sitting under investing or financing. In general, bank overdrafts that are repayable on demand, we would expect to see in cash and cash equivalents. And short-term investments, sometimes you need to do a little bit of a deeper dive. Okay, so just a little crib sheet. You can come back to this. And that's it from our messages. And we'll move on to the next slide, which is on some of our hot topics. So how have we come up with these hot topics? We have looked at our experience. We've looked at what the IFRS is saying. We've looked at what the ESMA is saying, and just generally what is out there in the market. And we've sort of come up with 3 hot topics that we think are important to keep in mind for your December reporting. So if we start off on the next slide with number 1, which is on inflation. So again, you probably have heard this. Inflation has been an issue, and in particular in the UK, where it had double-digit inflation, which peaked in October of 2022. So reporting on the effects of inflation and other uncertainties is probably something that's going to be with us for a while. Just this year, in September of 2023, Reuters reported that Britain remains on course to have the highest inflation of leading rich economies in 2023. So what does that mean? As a reporter and as a preparer of financial information, it means that we need to assess the impact of high inflation and the related effects, such as increasing interest rates and exchange rate volatility. And that can have a number of impacts. And so we've listed some of these on the slide, and I'm sure some of you have probably heard about some of this before. So this is kind of a nice one-pager to come back to. High inflation and rising interest rates may drive significant changes to discount rates and expected future cash flows, which can have effects on a number of our balances. So it can affect, we can have additional impairments. It could reduce pension scheme liabilities, potentially result in the recognition of a surplus. What it also does is bring in a range of uncertainty in a number of economic factors. And that does mean, if we go back to where we were discussing about judgments and estimates, that potentially there's areas that now require more judgment or more estimation uncertainty, which will then drive additional disclosure. So what should you do? So after having considered the potential impacts on the financial statements, it's important that the financial statements explain those risks and the changes in the business environment and how they impact the company's position, performance, and prospects. And then consistency is key, as we've mentioned a couple of times, making sure that any assumptions that you're making are applied consistently throughout your financials. Okay, and then if we move on to the next slide, which talks about climate-related matters. Again, probably not unexpected that climate is something that is a hot topic, especially we've got the COP28 happening at the moment. So issuers should consider climate-related matters when they're preparing financial statements. And potentially there's an impact now, but even if there isn't a material impact on the numbers at the moment, we are seeing an increase in investors expecting to see disclosure on climate-related matters in the financial statements in the annual report. And so the key with climate, and the thing we think is going to be really something that the regulators are looking out for, is, again, this word consistency, because a lot of the climate discussion happens in your front end, and that should then flow through where relevant to your financial statements. So if you're making any statements and you're making net zero plans and you've got targets around there, how does that then impact your financial statements? And so there should be this common thread. The other big climate-related matter is around impairment. So climate-related risks may significantly impact useful lives, residual values, and decommissioning obligations, and possibly result in the obsolescence of items of PPE. And so these risks could constitute indicators of impairment and impact the estimation of future cash flows that are used in impairment testing. So just to keep that in mind. And then on the next slide, our last hot topic is fair value measurement. And you can kind of see a common thread here. It's all about uncertainty. So in the current macroeconomic situation, there is an increased level of uncertainty that may exist with when it comes to the determination of fair values. Now, changes in fair values may have a material impact on an entity's financial position and performance, especially when issuers apply the fair value model to measure things like investment property or to estimate the recoverable amount of their assets for impairment testing. And so regulators expect that in the current macroeconomic conditions, so for example, where there's high interest rates, there's vacancies when it comes to investment properties, that those are then reflected in the issuer's fair value measurements, in particular where you've got level 3 inputs. So even for those entities that don't have items measured at fair value, remember that IFRS 7 does require the disclosure of fair value for each class of financial assets and financial liabilities, including those measured at amortized cost. And so it's still relevant even if you don't measure items at fair value. Something to also keep in mind linked to climate is that commercial properties will have to meet certain energy ratings, and so that could impact your valuations going forward. So it's all very intertwined. All right, and that brings us to the end of our messages from regulators, and I'll now hand back over to Moses to talk us through some other corporate reporting developments.
Thanks, Raisa. If we just move over to the next slide, please. So again, this is a reminder, we've covered most of these things off in earlier webinars, but if you've got a December 23 year end, then there are new requirements in the Companies Act, which are broadly based on TCFD. So if you've done TCFD in the past, this shouldn't come or be anything new, but certain large corporates, including some AIM companies, will be required to report under these regulations. Then people are calling them CFD, so you're dropping the T off the TCFD. Again, like I said, we've covered that off in more detail in our March webinar. Excuse me. Then on the next thing we've got here is an update that from 2024, the ISSB will assume the responsibilities of the TCFD. So the TCFD will be disbanded. I still think we'll probably still refer to the TCFD as the originators of all this sustainability guidance that we have to do, but like I said, it's just an information point. And then what's new? The transition plan task force. This was has been set up to produce a gold standard disclosure framework for transition plans. So that's kicked off its work, and again we expect this to be referenced in the FCA listing rules. So if you're a listed company, it'd be worthwhile keeping up to date with what the FCA, with the pronouncements the FCA makes in this area. So if we turn over to the next slide, we'll be moving on to UK audit and corporate governance reform. And I suppose this is maybe the good news slide for some. The government had tabled some legislation in the statutory instrument back in July. However, well, it's a couple of months ago now, or a month and a half ago now, these draft regulations have been withdrawn. And again, we've covered these off in an earlier webinar, but there was disclosures about material fraud statement, audit policies, and all of that's been withdrawn for now. Again, we'll see what the next steps are in this the government takes, and this again something else to keep a watching brief on. The justification the government gave for dropping these reforms was to do with reducing red tape for companies after having listened to their concerns, particularly where we are in the economic cycle. It was felt that these changes would bring additional burdens to companies that and with those additional burdens, additional costs, presumably. In terms of what impact that has on the financial reporting, corporate governance, the FRC's corporate governance code. So again, all of these changes had been anticipated into the new draft of the code that was exposed earlier. So a lot of those were reflecting what the government proposals were, so those have now been dropped. However, the one thing that the FRC is pressing on with is reporting on internal controls. However, they have gone to great pains to emphasize that it won't be like US SOX, but again, something to watch out for when it comes out. We're expecting the new code to be released in January 2024. And as a final point on this, the proposals to reform auditing frameworks have not been prioritized in the next parliamentary session, as neither has have we seen any concrete proposals for the creation or the new regulators to replace the FRC. So again, something else to watch out for in the future. We've been promised change for a long time, but it seems to be taking a long time to come. So if we just move on to the next slide, again, this is just a wrap up. Again, in this section, we just got, and this is more for when we circulate these slides to you. Moving on to the next slide, just highlighting a few of the resources that are available to you. Sustainability reporting, a Q3 update. Hopefully, we'll have Q4 one coming out soon. Information on which economies are hyperinflationary. Again, the different IAS 29 applies to the where you've got a hyperinflationary economy. We've updated also our guidance to IFRS 16. So again, something else that's available. Moving on to the next slide, we've got a new publication coming out. I think it's come out earlier this week. As subscribers to these webinars, you ought to be receiving it. If you haven't, then please click on the link on the slide when you get them to so you can receive it. Again, it's focusing on topical issues in corporate and financial reporting. We hope you'll find it interesting and informative. Moving on, again, some links to the latest regulator publications, thematic review on IFRS 17. Again, this was a review of insurers. Again, if you're in insurance, you probably worth going and having a look. The annual review of corporate governance reporting, which Raisa mentioned earlier, there's a link there, and the materiality and practice statements, which again might, which you think you might find helpful when, particularly when applying the changes twice, one in relation to material accounting policies. And that takes us on to the next slide, which is Q&A, and we've had a couple, which I'll attempt to answer. So the first question we have is on material accounting policies, and the question we have is, well, is it now necessary to say something boilerplate like they're measured at lower of cost and net realizable value? And I think the answer to that is quite an interesting one, because I hadn't given this any thought, but IS2 does have, or does mandate, or does allow different accounting for different types of stocks. So generally it is cost NRV, but if you're a commodity trader, you're allowed to hold them at fair value. So I'm not sure that one ought to be dropping it, but the point, the question then goes on to ask, should you be disclosing whether they're FIFO or weighted average and any other funnies? And I think that is getting to the nub of the requirements. It's about telling you, well, what is important in your stock. So perhaps you're making big judgments in costing. Are you using standard costing? If you do, then how might you account for inefficiencies, and how do you decide how much is an inefficiency and what is or what isn't an inefficiency? So to my mind, I think, yes, we might expect to see some companies drop the cost, the NRV disclosure, although I'm not sure too many will, because it's only one sentence and it's not but maybe about adding more information as to whether you use FIFO, LIFO, weighted average cost, but also in terms of your costing, or perhaps even in terms of your provisioning. How do you do your provisioning? Yes, you how do you estimate net realizable value? What judgments are you making when you make what costs do you include when you are estimating net realizable value? That type of information is information that I think a user would like to know as to how you account for these. So I hope I've answered that question. Then we've got a question on the cash flow, which I'll attempt to answer. And the question goes, movements in working capital won't necessarily tie in if you have an international group with balances in a foreign currency. How did the FRC address this in their desktop reviews? Well, I don't have an insight into necessarily how they would do it. And sometimes something like foreign currency exchange and differences, again, going back to my experience when I was an auditor, that's where we used to find the fudges sometimes. But as an auditor, you have more access to more information than perhaps the FRC might have. So I'm not sure they would pick that up, although they might ask questions about foreign exchange on your cash balances and how you've dealt with those. But I agree that on working capital, unless you're doing the direct method, it's not easy to discern whether there's an issue on the translation of working capital in the cash flow statements. So that's it for.
Yeah, I mean, I'll add to that, Moses. I think Ben also had an interesting question. I think with those procedures that we've listed, that you could potentially include as part of a robust pre-issuance review, as referred to by the FRC, they won't always equal. So your working capital movements won't always equal your movements in your balance sheet. Your asset additions in investing activities won't always be the same as your asset reconciliation, for example, because you could have financed that asset purchase, you could have prepaid it, etc. But the procedure is meant to highlight that. So if you find those amounts do agree, then you can say, right, does that make sense? And if they don't agree, then you can again ask yourself, well, does that make sense? And it is really just that trigger, that procedure is just a trigger for, picking up if there is an issue in your cash flow statement.
Thanks, Raisa. And yeah, it's hard to second guess what the FRC do on these, but those are the types of things that we would do ourselves when doing those pre-issuance reviews. You don't expect everything to agree all the time, and if it does, that's probably the flag to ask the question. And then clearly you've got materiality to say, I might have some fixed asset debtors and creditors, but and then if the impact's not material, then you can go with a number in the reconciliation. It's not to say it's wrong, but ultimately it's become then a materiality judgment. So I think that brings us to the end of our session today. Thank you all for attending. We hope you've enjoyed it and found it useful. We'll be advertising our dates for the new year in the future. So see you in the new year. Thank you.